So Ackman wants to create a modern day Berkshire Hathaway. Okay, bye. Okay, let's begin. I'm here, Bill Ackman, with colleagues Ryan Israel, Chief Investment Officer of Pershing Square, Roth Alamanda, who's a partner and member of our investment team, Ben Hakim, who's our president. I'm going to walk you through a number of slides. We are at the end of the presentation. We're going to have to switch to a Spaces so we can take live questions. We'll probably give a bio break between the two. So to begin, just summarizing the transaction, we are going to be investing, if the transaction takes place, $900 million and buying 10 million shares of stock from Howard Hughes at $90 a share. This is a primary purchase of shares. The $90 price represents a 46.4% premium to the $61.46 unaffected price. That's the price prior to our filing a 13D saying we were looking or considering a going private transaction. We're funding the transaction with cash on our balance sheet, and there is no need for financing. Our ownership of the company will go from 37.6% to 48%, and the transaction itself will not represent a change of control. We intend to, for the Pershing Square funds to retain their existing stake in Howard Hughes. What's great about this version of the transaction, or severalfold, but one of the most important parts is speed to completion. We can complete this transaction really as quickly as we can execute documents with the board of directors versus probably a 6-month period to do the previous proposed transaction. We raised the price from $85 to $90 per share, a massive premium. Normally, you would see premiums like this in change of control, going private transactions. Here, we are simply buying stock from the company, a large stock purchase of the company to improve its capitalization. Typically takes place at a discount to a market price, and here we're paying a 46% premium. The cash coming in enables Howard Hughes to begin executing on its strategy immediately, versus our previous transaction would have taken significant time. And actually, because the capital was going out to shareholders, the company itself would not be well capitalized. Versus today, we'll have $900 million of excess cash sitting on the balance sheet in addition to the company's existing cash resources, which are needed for its real estate subsidiary. The infusion of cash will be creating a credit rating positive event for the company, and of course, meaningfully improves the company's financial wherewithal and flexibility. No change to the post-transaction float, no incremental debt, and we don't need to raise any capital to complete the deal. This is sort of a chart that shows our increase in ownership. The company's shares outstanding increases to 60.1%. Our stake goes up by $900 million. To be clear, these shares are being purchased by Pershing Square Holdco. That is the holding company for Pershing Square Capital Management. That is the alternative asset manager, the management company for the Pershing Square funds. I own about 44% of that company. The investment team, 45%. The investment team and other members of the firm own another 45%, and a 10% balance is held by other investors. The Pershing Square funds will own about $1.7 billion stake, retaining their existing holdings. And as a group, will be 48% of the shares, with the public float at 52%. If you look at our sort of what we call the look-through ownership, that is the ownership that the investment team members, myself, and other partners of the firm own in Howard Hughes. Post-transaction, we will have a look-through ownership stake of approximately 14.3 million shares, or $1.3 billion investment at $90 per share. This is the second largest investment I will have personally, other than my stake in the Pershing Square Holdings. Post-transaction, Howard Hughes becomes a diversified holding company that pursues the acquisition of controlling interest in private and public companies. The senior leadership of the holding company becomes myself, Ryan Israel, Ben Hakim, and the full resources of Pershing Square, the entire investment team, accounting team, legal team, technology team, investor relations, capital raising functions, and more will become now available to the company. We will take no cash or stock compensation as employees of Howard Hughes. The Howard Hughes Corporation real estate subsidiary will remain unchanged, continue to be led by David O'Reilly and team, Carlos Olea and team, who've done a superb job with the business. The business today is a highly focused master plan community company in light of the spinoff in August of some of our non-core assets. We are, in lieu of being compensated as employees of Howard Hughes, we are charged consideration for services rendered. We receive, in the proposed transaction, 1.5% of the market cap of the company, paid on a quarterly basis. We've received no promotes, no options, no performance fees or other equity incentives. And we're going to discuss the fees or sort of the fee in greater detail. I noted a meaningful number of questions and concerns about this. We'll cover it later in the presentation, but just to quickly point out that we are in the alternative asset management business. We charge our clients a 1.5% management fee for all of our funds, and anywhere between a 16 and a 20% incentive fee, which is paid on an annual basis on realized and unrealized gains. So a 1.5% fee in this case would represent, without a performance fee, would represent a very substantial discount to what we normally charge, but we'll go into that in some more detail. The company looks like this the day after the transaction. The holding today at Howard Hughes, at the holding company, really is little, if any, activity. Really, all of the operating activities of the company today take place at the Howard Hughes Corporation subsidiary. Envision we take a couple $100 million and we make an investment in operating business number one. It becomes a subsidiary of the holding company, and over time, we build a base of operating assets. When the operating assets generate excess cash, the excess cash can be repatriated to the parent, the holding company, for reinvestment. To the extent one of the operating businesses, including Howard Hughes Corporation itself, has attractive opportunities for investment, the holding company can send capital downstairs. So those businesses have access to incremental and important resources. We intend for the company to continue to have best-in-class corporate governance. Remains a New York Stock Exchange listed company. There's no change in the float. We will commit not to, squeeze out the public shareholders. We won't buy back stock other than, of course, with approval of the board of directors. The board itself will remain an independent, controlled by a majority of independent directors with an independent audit committee, compensation committee, nominating corporate governance committee, and it will not be a controlled company under the NYSE and SEC rules. This is just a chart of the company's stock price relative to the S&P 500 index, Dow Jones index, and the Dow Jones Home Builder Index. And what you'll note is the stock, since we announced the transaction, has traded at a consistent wide spread to sort of the collection of indices that it normally trades with. Home builders have been under pressure, including today. I know Toll Brothers, I think, earnings this morning. But the reason why the stock is traded at about a 22% premium to the other to the unaffected price, while the comparables have on average are flat over the same period, of course, is the expectation on the part of the market, and then our proposal that we made early in the year, and now, of course, our revision to our proposal. Howard Hughes stock has not traded above $90 a share since early 2022, when the Fed began raising interest rates aggressively. Obviously, the company has, as a real estate business, a lot of exposure to interest rates, and that really accounts for the decline since that period of time. So 90 is a very large premium to the trading price of the stock on an unaffected basis, and even a large premium to where the stock has traded since our bids have been announced. Just point out that I've been on the board of this company since its inception. In 2019, we considered selling the company. We hired Centerview, a very highly regarded firm, and we did a full court press to try to sell the business. And while a lot of people sort of did some digging and homework, think the big private equity firms, some I would describe mega family offices, ultimately we got no bid, and we had to withdraw the transaction. We figured, as a more simplified business with the Seaport spun off, that we would have a better chance taking the business private, and we hired Jefferies to take the business private post our announcement of looking at transactions. Working with Jefferies, we put together a very good materials, a data room. Jefferies approached 284 investors. Of those, 40 signed NDAs. We provided access to a data room. Of those, 20 had Zoom or in-person meetings with us. And 4 months in, we did not receive a formal expression of interest or even an informal indication of participation. We had a number of investors, I would say, who were interested, But what we struggled with was, despite the fact that the investors we approached, one would describe as long-term, really every one of them wanted to see a path to liquidity within some period of time, whether it was 5 years or 7 years or 10 years. And the problem is, it's very hard to create, to guarantee to an investor that that there's a path for liquidity, and that makes it a very challenging transaction for a person who wants to take the business private. And faced with that inability to sell the company in 2019, our inability, it appears at this point, to take the business private, and actually feedback from shareholders who said, look, Bill, if you're buying at $85 a share, I'm not inclined to sell. And that's when we started thinking about alternative transactions. The first cut at that was the transaction we proposed, where we were buying out a percentage of the shareholders, if you will, squeezing out shareholders at 85, combined with the self-tender from the company. And then with feedback from the company, concern about the balance sheet of the business. And then as we did more due diligence on the company's operating cash flows after required equity for development, we realized the business itself, Howard Hughes, would not be in a position to generate meaningful cash for distribution to really beginning 4 or 5 years from today. The company itself, Howard Hughes, the board always likes to keep a fair amount of cash on hand. Our goal typically is an order of 500 million of free cash. The business won't be in that position for 3+ years. And with some announcements you'll hear in the upcoming earnings release, the company has some incremental development opportunities that are likely to consume more equity capital. So our initial thesis was, okay, we'll take control of the business. The excess cash of Howard Hughes will invest in building a company. The more we looked, however, the more we realized that could not start for 3 or 4 years in terms of excess cash, and not material excess cash, not for 5, 6 years. And that's assuming no incremental development opportunities presented themselves. And that's what led to the revision of this transaction, and where we're buying primary shares from the company at a very substantial premium. The other thing I just sort of want to point out about the business and why Howard Hughes has kind of struggled as a public company. We've been a shareholder for 14 years. If you look at how the stock has performed since we invested, along with Blackstone and others, in a rights offering, November of 2010, at a $47 share price, the business was $61 and had not paid a dividend other than a couple dollar distribution of Seaport over a 14-year period of time. So a 2% compounded return over 14 years, not something to get excited about. And why? And I think the answer is a few things. One, this is a complicated business. For real estate investors, it's not a REIT, doesn't pay dividends. It's development intensive. 2/3 of the assets are land. Land is considered a volatile and risky asset. The business has a lot of economic sensitivity, interest rate sensitivity, and has limited ability to hedge those risks itself. The company itself, in terms of access to capital, has really been reliant on Pershing Square from the day we capitalized the original rights offering to March of 2020. The company really had to do almost a rescue equity offering. The company's a bit over its skis after entering into a bridge loan to acquire an important asset going into COVID, and the company needed to raise capital, and we raised our hand and backstopped, in fact, a $600 million. It wasn't a rights offering, it was an equity offering, but the point remains the same. And then again, in spinning off the Seaport, we stepped in for the company. All of these cases, and we've never taken compensation from the company. It's extremely unusual for a financial participant to backstop a rights offering and not get paid some form of fee, but we took no fee for doing so. The other thing that we looked at and thought about over time is there another way to unlock this quote unquote sum of the parts value of Howard Hughes? And the problem there is a few things. One, it's a C corp. We've got very low tax bases in our assets, and I would say even more significantly than that, the income producing assets of this strategy, the reason why we've maintained high occupancies in our office space buildings, for example, is because of the nature of the MPC business, where we're not competing with anyone, or very little competition in terms of other people owning buildings in our small little cities. And that changes the course if you sell off the assets individually. And then there really is no buyer for our very large land holdings. You can sell those land holdings over a very long period of time, a small percent each year at an auction. But if we put on the market a few thousand acres in Bridgeland, one of our master plan communities, for example, the price would be a fraction of what we would get selling to home builders in a retail versus a wholesale type transaction. So to kind of summarize this proposed transaction, really two questions that we asked the board to consider, and now we're presenting these questions to shareholders. Should Pershing Square be allowed to increase its investment in the company by buying 10 million shares for $900 million, take our stake from 37.6 to 48%. So first, the transaction itself is not a change of control. At 37.6%, we're already obviously a very influential shareholder of the company. I don't think our influence meaningfully changes when we go from 37.6% to 40%. We already had permission from the board to go to 40. So really what we're asking is for the right to go from 40 to 48%. The $90 share price, obviously a very large premium to market, very large premium to the unaffected price. Obviously sends a strong message about our confidence in our ability to create value from a $90 share price. The infusion of cash, credit ratings positive for a company that is a below investment grade, BB- type issuer. And so that's a nice comfort in an uncertain world. And the board itself remains an independent board. So we think question number one is really an easy question. Second question is, does the company want Pershing Square to take over, in effect, the management of the holding company and change the business strategy of Howard Hughes Holdings into building a diversified holding company? And then should Pershing Square be paid for doing so, and what form of compensation? So let's start with what we call our value proposition, what we bring to the table, and then we'll go in depth on fees. So just with respect to the team, and I'll walk you through the investment team, 133 years of public and private equity investing experience on the investment team. And it's not just a 9-person investment team that we're bringing to the table. It's full access to our entire organization, resources, office space, capital raising teams, legal, accounting, technology, and otherwise. One of our core capabilities that has been a big driver of our returns and also helped mitigate our exposure to various macroeconomic and geopolitical risks is what we call our asymmetric macroeconomic hedging capabilities. I'll go into those in some more depth. We are good at doing research on companies and doing due diligence. Those are core skills, obviously, for in identifying and investing in acquiring new businesses. We do have a demonstrated track record of creating value at a large number of companies over our 21-year history. We certainly see unique deal flow, and we have done privately negotiated transactions. Our mandate for the Pershing Square funds is limited to the public markets, even though we have done privately negotiated deals. And the team itself has enormous private equity experience in terms of their backgrounds, which we'll talk about. And we think the company, by virtue of our involvement, will have massively improved access to raise additional capital on an as-needed basis. Here's the investment team. And if you look at the tenure of the team, Pershing Square is, I would say, quite unusual. Most investment firms, most hedge funds have enormous turnover on the investment team. You see people, the millenniums of the world paying $50 million to recruit someone from Citadel, for example. Here, Pershing Square is a place where people come and build a career. Brian's been here for 16 years, Ben for 13, Anthony 12, 11 for Charles, and so on. We just recruited a new member of the team, and our ability to recruit talent, I would say, is unique. We basically got a resume when we announced we were looking for a new analyst from every associate, if you will, at an Apollo, a KKR, Warburg, a Blackstone, seeking that one job opportunity. Sonal Khosla sort of won the contest, and she will be joining us in May. And really, it's our ability to recruit talent, the unique, I would say, culture and economics, and just this is a very interesting place to work. Allows us to literally recruit the best and brightest from the top private equity firms, which are really the training ground that we use to recruit talent to Pershing Square. You'll note the backgrounds: Goldman, Blackstone, Apollo, KKR. The KKR school has been very good to Pershing Square. Hellman Friedman Warburg, and again, another KKR, if you will, graduate joining Pershing Square. This is the org chart. Unusually for a firm that today manages, I don't know, 17, 18 billion of assets, it's a very small team. And when you have a very small team, the economics of working in a place like this are extremely attractive. The culture is much more interesting. And if you notice the tenure of the team members is very, very long, beginning at the reception desk. And at the administrative team, Saritz has been here 21 years. Megan and Mercedes 6 and 5. It tells you something about a firm when there isn't even turnover at the reception desk. Unique culture, very attractive economic characteristics, and a partnership culture. With respect to our investment here, we are big believers in investing in our own funds. We have a 28% stake in the Pershing Square funds that we manage, and the Pershing Square funds in turn have a 38% stake in Howard Hughes. So as we describe it here on a look-through basis, the people making the investment decisions for the new Howard Hughes and helping oversee the company will have an $810 million investment. Those are the investment team members. And in addition to that, another $475 million by virtue of the 28% ownership we have in the Pershing Square funds. Of that total, I will have a $764 million investment, and the rest of the Pershing Square team will have a little over $500 million investment. So what is happening here is a new management team that's coming on board to run the holding company, and we're adding an extra $810 million to our investment in the company, a personal investment. This has to be the largest investment probably ever made by a new management team stepping in to run a public company. My look-through investment will be $764 million. The only other investment I have, anything close to scale of that, is an investment I have in the Pershing Square Holding public entity. If you look at our results over the last 21 years, we present here the S&P 500, which is up eightfold, which is not a low return, I would say, over that 21-year period of time. The funds net of the fees, the incentive fees we charge and management fees, have been a 25-fold return, more than 3x the returns of the S&P over the same period. The green line, we show what our returns would have been if we only charged a management fee. That's relevant here, of course, because we're not charging incentive fees to Howard Hughes. So it's been a 4,441% return, or a 45.5x return. If you invested $10,000 in January 2004 and you didn't pay the incentive fee and just the management fee, you'd have $455,000 today. If you look at our firm's history, there's sort of three periods as I describe them. The first 11.5 years, we could do, I would say, pretty much no wrong. We started out as a activist investor, buying stakes in companies and getting Wendy's to spin off Tim Hortons, taking stakes in Canadian Pacific, taking control of the board in a proxy contest, bringing in new leadership. Very successful, very profitable strategy. We made a very large and very disappointing investment in a company called Valiant Pharmaceuticals in middle 2015. That investment lost 85% plus of its value, and that led the world to believe that Pershing Square was going to be forced to liquidate. At that moment in time, about 70% of our assets were in open-ended hedge funds, and those redemptions, which people were right to anticipate, forced us to sell other holdings, and that led to this. You see the line down in the chart. We had a 30+% drawdown, and that led to a change in strategy. We decided to get out of the open-ended hedge fund business. So we didn't liquidate those funds, but invest anyone wanted their money, took their money. And we really focused our energies on growing Pershing Square Holdings, which is our European public entity that now comprises 93% of the assets we manage. The permanent capital era, as I call it, began in January 2018. That's when we basically got out of the open-ended fund business. We have a small remnant of that business, 7% of our fee-generating capital today. But if you look at our results over the last 7 years, it shows you the power of having permanent capital, not having to worry about money flows in and out. This is a tombstone that we created back in 2017 after going through that challenging period. We took our core investment principles. They were supposed to be engraved on a stone tablet, and the team came back with a deal toy, but it's really achieved the same purpose. There's one of these sitting on my desk right next to my computer. And these are the core principles of the firm. We look for simple, predictable, free cash flow generative businesses that have very high barriers to entry, businesses that have limited exposure extrinsic factors we cannot control, strong balance sheets, an attractive valuation, of course, and we want businesses that minimally reliant on the capital markets, don't have to constantly raise capital in order to succeed. And of course, we like excellent management and good governance. We've been around for 21 years. I've been in the investment business since my first fund, which I started in 1992. And over that period of time, we have built a lot of relationships. We have entered into lots of interesting partnerships. I've been pretty active personally. I'm not permitted to make public securities investments personally, but I've been an active investor in both venture and private equity. And the team all come from private equity backgrounds. Pershing Square has built a brand name, and we get approached all the time about investing in private companies, opportunities that we have to turn down because our mandate today does not include the ability to invest in private companies. We also focus on large cap companies, generally mega cap and large cap businesses in light of the nature of our capital base. Actually, Howard Hughes is really the only small cap company we own, and that's by virtue of an investment we made in General Growth years ago that it was spun out of. We do think there's a very interesting opportunity set in the public markets, opportunities to buy control of smaller companies. If you look at the S&P 500's massively outperformed the small cap index, by 640 basis points per annum. The small cap stocks trade on average at 16 times earnings versus the S&P at 22 times. And we still think there's some interesting gems in the small cap world that we've had to pass on because we haven't had an entity or a fund that we could use to pursue those investments. There are other investors, of course, that can buy private companies. I think what's unique about Pershing Square is the nature of our strategy is one, we know how to buy large stakes in public companies and get, historically something pretty close to control without paying a premium. Those skills are very valuable when we actually decide to get control of various businesses. And that we think the Howard Hughes Holdings opportunity set will certainly at its earlier stages be focusing on kind of the smaller cap universe and smaller private companies. If you look at our record on a compound annual basis, and again, here we show the net return, net of the 20% and 16% incentive fees we've charged historically, and then we show the results without an incentive fee. Again, here we will not be charging incentive fee. The results have been 19.8% compounded. That's a 935 basis point outperformance versus the S&P. If you look at the permanent capital era, that's the last 7 years, the results have been extraordinary. 27% compounded for the last 7 years, 14%, versus the S&P at 14%. That's a 1,300 basis point annual outperformance versus the S&P. Most investors think, over any decent period of time, if you can beat the stock market by, or the S&P 500 by 100 or 200 basis points, you're a superstar. And here our results are, I would say, off the charts. I believe certainly in the last 7 years, I am not aware of another investment manager that has generated similar returns. And over the last 21 years, at 19.8%, these are at the absolute upper end of equity performance. A big part of our success as an equity investor comes from the fact that we always focused on risk, mitigating risk, hedging risk. And part of our strategy from the early days was thinking about macro risks, geopolitical risk, political risk, and hedging what we call black swan risk. And we do so by using option-like instruments that have limited finite investment and theoretically unlimited upside. And what we like about this is it helps hedge downside risk, and it's a method for us to get access to large amounts of capital when very bad things happen. If you think about Howard Hughes's business, going back to its formation, General Growth went bankrupt during the financial crisis because it lost access to capital, and because the MPC business, which at the time was within the General Growth company, they stopped selling homes, and so lot sales ended. They literally didn't sell a lot, I believe, for 2 years, and those cash flows General Growth was relying on in order to meet debt service that led to the bankruptcy of General Growth during the Great Financial Crisis. And it just shows you, some of the economic sensitivity of a business reliant on selling lots to home builders. COVID-19, Howard Hughes stock declined 71% over a 30-day period of time. And part of that was a little bit self-inflicted. The company purchased the Anadarko buildings in the Woodlands and had to do so by year end in order to win the bid. At least that was the view of the company. And then got stuck with a bridge loan going into a very uncertain period, and the board prudently raised capital and asked us if we would step in to help the company. But again, a massive decline in value and a dilutive offering in order to get the company balance sheet right-sized. And then most recently, with the Fed raising rates, stock went from 102 to $55 a share. This is a levered long-only company that owns real estate assets, and the most volatile real estate asset, which is land, comprising about 2/3 of the enterprise value of the company. So there is a lot of sensitivity to interest rates. Now, if you compare what Pershing Square did over the same period, we were very concerned about the growing credit risks in the market beginning as early as 2005. And we spent a small amount of money on on credit derivatives. These are instruments where you pay a premium every quarter. And if bad things happen, i.e. credit spreads widen, these instruments become much more valuable. We spent $64 million on premium. We collected $1.1 billion of profits when proceeds from the sale of these instruments when the credit markets imploded, 17.5-fold multiple of the capital invested. And then we took that capital and we reinvested that capital in the 2009, buying very cheap stocks when the market bottomed, call it March of 2009. $1.1 billion sounds like a decent amount of money, but it was, relative to, we were managing about $4 billion at the time. So it gave us a very large chunk of cash that we can invest in the market when stocks were cheap. Same drill, COVID-19. In January of 2020, we became increasingly concerned about the risks of COVID. By February 23rd, I think it was, we had concluded that this was going to, the government was going to have to effectively, governments around the world were going to shut the global economy. This would be a credit event like no other expected by markets. And credit spreads were at the all-time tightest levels. We bought about $74 billion of investment grade CDS and some high yield credit default swaps. Those instruments made our investment over a 10-day period. Spreads exploded. We sold the swaps, collected $2.6 billion, and we were buying stocks at the bottom. The proceeds, 93-fold return on the premium invested. Then beginning late December 2020 and then early 2021, we started buying. We bought $104 billion of 2-year interest rate swaptions. These were out of the money instruments. The 2-year treasury was at 12 basis points. If I remember correctly, the strike price was around 93 basis points. It's a bit like buying a call option on a stock that was 7-fold out of the money. 93 basis points sounded a lot relative to 12, but 0.93% interest rates sounded very low in light of our expectation for massive inflation. This was, if you can remember, a period when you had the most aggressive monetary policy of all time. We had extremely aggressive fiscal policy. We had the Biden administration with the Build Back Better bill and large commitments to invest our taxpayer money. And then, of course, we had the vaccine and the world reopening, all of these things coming into the world at the same time. We said, look, this is going to lead to explosive inflation. And we made a $112 million investment in swaptions. And then that increased in value by 11-fold. We took the profits, or some of the profits, and bought another tranche when we sold the first one at a higher strike price and extended the term and made another $1.3 billion. But the point being that had we been part of the Howard Hughes enterprise, these are the most liquid instruments in the world. We could have done the same thing for Howard Hughes and helped the company hedge exposures. But we were not able to do so, of course, because we were not running the company at the time. Howard Hughes did not have the resources or the relationships or the banking relationships or the skills in order to do so. But we think this skill set is obviously valuable for investing in companies and markets, but very valuable for a company that has economic exposure. The hedging capabilities of the firm are something that we've built up over the last 21 years. It's a systematic process. On a daily basis, we're looking for interesting opportunities to take advantage of sort of dislocations and potential risks that appear in the marketplace. Not only do you have to be good at identifying these opportunities, but you also have to know how to execute them in a way where you have minimal market impact and you can come and go without a huge impact on the market. You're dealing with counterparties where credit matters. You have to negotiate credit agreements and have arrangements that are favorable so that if your counterparty fails, you always have U.S. Treasury collateral protecting your investment. If anything, the world has become a much more volatile place in recent years, and we think this capability is a very valuable one that we would bring to Howard Hughes if we were so appointed. This is just sort of a list of companies that we took an active role, and the active role varied anything from taking a 10% stake in Wendy's and having them spin off Tim Hortons, catalyzing the sale of Sears to Kmart. We have a long list of companies that we could go through here, but in each case, a wide range of engagement, everything from governance transformation, think adding directors or replacing a board in a proxy contest, recruiting CEOs, Brian Niccol to Chipotle, Hunter Harrison to Canadian Pacific, Sefi Ghasemi in the earlier days to Air Products. We have a competency in recruiting top talent, giving them the right incentives and letting them do their thing. Major operational turnaround stories, Chipotle being obviously and Howard and Canadian Pacific being two great examples in very different industries, helping businesses reorganize. We were an investor in Fortune Brands and we're a catalyst for them separating into a golf company, Titleist, Beam, and Fortune, the hardware, Fortune Products, the hardware manufacturer. We've been General Growth. We bought 25% of the company, the common stock, prior to Chapter 11, and we led a reorganization of the company. And it is considered by many the most successful bankruptcy restructuring ever. The creditors, 27 billion of creditors, got par plus accrued, plus default and late fees. And the shareholders, the stock went from 34 cents a share to $31 a share during our ownership. Obviously, a lot of experience in the capital markets. We've done numerous capital markets transactions. Capital allocation is a core competency of the firm, and we're always an advocate for the shareholders, and we help companies tell their stories to the market. We've done a lot of transactions in the kind of privately negotiated world, and we spent a lot of time on boards working with management teams. And I pretty much know every CEO in America, or I'm one person removed from every CEO and or board director in the country. The team has enormous experience, pretty much everyone coming from a private equity background at a top firm, and a lot of success. We've had a few failures, most notably an investment in Valiant Pharmaceuticals, an investment in JCPenney. We lost money shorting a company very famously called Herbalife, but those are the small, less than a handful of problematic investments, and a very long list. We have a very, very high batting average of success that has enabled us to compound what we call our reputational equity over time, and that's led to great long-standing relationships with management teams, boards, important institutional investors, and we've built really a following in the retail world. We did a transaction. We took Restaurant Brands public. This was at that time Burger King, a transaction we did with 3G. That they were the controlling shareholder. They took it private. We took it public with them. We remain a shareholder 12 years later. It's been about a 14% compounded return. Universal Music, we were chosen by the Bolloré family and Vivendi to help take that business public. We have the nature of a hedge fund manager, alternative asset manager, is you build relationships with private sources of capital. And so, we're known by pretty much every family office, insurance company, pension fund, sovereign wealth fund. Many of the investors have been investors with Pershing Square over a very long period of time. Broad retail following. I did a everything you need to know about finance and investing in under an hour video. It's gotten something like 40 million views that helped build a relationship with the retail community. Obviously pretty active on X. And that's a platform that we think is important. We've had some unusual success raising equity and debt in the public markets. Our Pershing Square Holdings is the largest permanent capital hedge fund in the world. It has 16 billion of assets, BBB plus S&P rated company with a positive outlook. We've got 2.3 billion of long-dated unsecured bonds outstanding. We raised the largest SPAC ever. Unfortunately, we were not able, the SEC would not let us close the transaction with Universal Music Group. So one, we had to close it outside of this SPAC, which was obviously very disappointing to those investors. But I promised all of them who stayed to the end that we would give them a free option on our next transaction. It took us 2 years to get through the SEC, $10 million. And about 15 or a dozen or so filings, but ultimately Pershing Square Spark Holdings, a new acquisition company, no founder stock, no shareholder warrants, no underwriting fees. We were actively looking for a large cap, high quality business to take public. And we've raised about $4 billion of equity for co-investment vehicles that we've done over time. These are a list of capital markets transactions we've done. In many cases, they were the first of their kind or the largest of their kind, or never been done before. The IPO of Pershing Square Holdings was the largest IPO in Europe at over $3 billion. The kind of benchmark $1 billion bond issue, largest of its kind for a publicly traded hedge fund. Lots of examples of unique structures. The services agreement. So I've read many of the comments on Twitter. I would say a lot of very supportive investors interested in what we're doing. I would say the only criticism we received is, of course, anytime you try to make a comparison to the great Warren Buffett or Berkshire Hathaway, you're subject yourself to potential criticism because that standard is very, very high. But I actually think the comparison is a fair one. And let me walk you through what we're doing and what the differences are. So number one, just to summarize, we're getting paid 1.5% in this transaction of the equity market cap of Howard Hughes going forward, paid on a quarterly basis. No promotes, no performance allocation, no performance-based fees, no equity, no options, no restricted stock. Typically, we charge all of our other funds 1.5% management fee and an annual 16 to 20% performance fee based on realized and unrealized gains. Here, there will be no equity-related fees. The team that is going to receive no cash or stock compensation as employees of Howard Hughes, the agreement itself is subject to termination for cause with customary cure rights. Other than third-party transaction costs, there are no additional fees or compensation expenses beyond the 1.5% fee for the services arrangement. So the question that we received, of course, is why does the services agreement contemplate a 1.5% fee rather than paying us typical cash and stock compensation, which is what most public companies do? And the answer to that is really twofold. First, I've got a day job which does not permit me to take a new role at another company in exchange for compensation, and the same is true for all of the employees of Pershing Square. The second point is what we're doing is we're allocating all of our resources or a portion of all of our resources to Howard Hughes in order to help Howard Hughes execute a strategy. Howard Hughes could not afford to hire this team, could not recruit this team for any amount of money, or just certainly within the context of Howard Hughes. And one way to think about this, the holding company itself is a shell. There's really nothing going on there. We're putting in place an entire organization with a 21-year history and relationships and access to capital and all the hedging and other capabilities I talked about. Howard Hughes couldn't hire that team on its own. If you think about the fee in the context of alternative asset, private and public funds, it's certainly at the lowest end of any such funds. When I made the Berkshire Hathaway analogy, the question became, well, Berkshire doesn't charge any advisory or service fee. Why are we doing so? And I think you have to look at our transaction in its entirety. Buffett bought control of Berkshire when the stock was trading at, I think it was practically a net way back when at $8-10 a share in the early 1960s. What we're doing is we're paying a 46% premium and investing $900 million in primary shares of the company. We're not a one-man band. We're bringing the full resources of a 40-odd person team, 9-person investment team into the company. And we're doing so in the construct in which we are allowed to do so. We're an alternative asset manager. We've got a fiduciary obligation to our existing funds. We have partners in our holding company. We can't quit our day jobs and go over to Howard Hughes and take it on. When people think about Berkshire Hathaway, they think about Warren Buffett working in a small office with a dozen people. And that's one way to think about Berkshire. But if you look more deeply, Buffett's is not a one-man band. His key executives are very highly compensated. Greg Abel, Ajit Jain, in the proxy. Their base compensation is, I think, the highest of any executives I've seen, in the high teens plus bonus compensation. They get 20-odd million a year. Ted Weschler, Todd Combs, who manage the Berkshire portfolios, get in excess of 10 million, purportedly in base cash compensation, and a profit interest of participation in returns above the S&P 500. Other than Buffett, every other employee at Berkshire is paid a market salary. We could not hire this team into Howard Hughes and pay them a market salary and come anywhere close to the management fee that we're charging. What we do on the pages that follow, and I'll have Bharath step in here, we do a comparison between what we're charging and what Blackstone or KKR, Brookfield charge for similar services. Why don't you go ahead, Bharath?
Sure. Thanks, Bill. So a natural starting point for these fee comparables are the traditional private equity funds managed by the KKR, Blackstone, Carlyle, et cetera. These funds typically charge between 1.5% to 2% in management fees and performance fees equal to 15 to 20% of investment gains. When you compare that to HHH, its 1.5% fee will be on the lower end of the private equity fee range, and there are no performance or incentive fees. Plus, it's a very simple and transparent fee arrangement with no monitoring fees or other hidden ancillary fees that PE firms typically charge their portfolio companies. And then even beyond the fee structure, the liquidity and governance provisions of these private equity funds are much less favorable. So on liquidity, private equity investors mainly realize liquidity through portfolio company sales and dividend recapitalizations, which are both heavily dependent on the capital markets with very limited visibility. And on governance, private equity funds are essentially fully controlled by their sponsor with limited board representation, disclosure, and other shareholder rights for investors. HHH, on the other hand, it will be publicly traded, will have its NYSE listing, and will have an independent board of directors. So in many ways, we actually think the more appropriate set of comps are the three publicly traded investment vehicles that Brookfield manages, BIP, BEP, and BBU, which are invested in infrastructure, renewable, and private equity assets, respectively. These vehicles share a lot of similarities with HHH. They're listed on the New York Stock Exchange. They're managed by a well-recognized sponsor with meaningful skin in the game. So Brookfield Corporation owns between 26% to 66% of these entities. And they have independent boards with very robust public disclosure. If we go to the next page and look at their fee structure, they're charged both management fees and performance fees. Their management fee ratio is 1.25%, but most notably, it's 1.25% of not just equity value, but of total capitalization. And Brookfield's definition of total capitalization includes both equity value plus the value of all their corporate net debt, which is effectively any debt that's not asset level financing. So if you were to look at it on an apples-to-apples basis, HHH's 1.5% fee on equity value really becomes a 1.15% fee under Brookfield's definition of total capitalization. So a full 10 basis points lower than what Brookfield charges. And then in addition to the management fees, the Brookfield vehicles are also charged incentive fees. And for BIP and BEP in particular, these incentive fees are 15 to 25% of these vehicles' dividends above a certain threshold. And the two key points to highlight here are one, these fees are paid quarterly, and for both BIP and BEP, their current dividends are well above their thresholds and quote unquote in the money. So although they're considered incentive fees, they're much more recurring and management fee-like in nature. If we flip to the next page, it's sort of clearest to see the combined impact of both management fees and incentive fees by looking at what these vehicles paid in 2024. And if we look at the red dotted box at the bottom of the page, it compares that total fee ratio on an apples-to-apples basis with HHH. And what you'll see is BIP's all-in fee ratio was 2.7% of its equity market cap, and BEP and BBU's all-in fee ratios are around 2% of their equity market cap. So 120 basis points and 50 basis points higher, respectively, compared to the 1.5% for HHH. Another interesting group of comparables are the non-traded perpetual REITs, with Blackstone's B-REIT sort of being the most prominent example. These funds have a management fee of 1.25% of NAV. But for a lot of their retail share classes, there's also upfront commissions of up to 3.5% of NAV and ongoing servicing fees of another 85 basis points per annum. With HHH, there's obviously no upfront commissions or ongoing servicing fees, regardless of whether you're a retail or institutional investor. Another important distinction is that HHH's advisory fees are calculated as a percent of market value rather than a self-reported NAV, which creates much better alignment for investors. So for example, in 2022 and 2023, these REITs received a lot of negative feedback from their shareholders because their NAV didn't necessarily reflect the declines that publicly traded comps saw, which meant that investors ended up likely paying higher fees than they otherwise would have if it were calculated purely on market value. And then on performance fees, these funds are charged 12.5% of the increase in NAV, and these performance fees get crystallized annually. So sort of similar to the Brookfield examples, it's instructive to kind of look at the all-in combined impact of both management and performance fees. And that's what we show sort of illustratively on this page for BREIT in a year where it hits a 12% target return. And if you, again, see the red dotted box at the bottom of the page, you'd see that between the management fees and the performance fees, investors end up paying an all-in fee ratio of 2.7% of NAV, which again is a 120 basis point premium to the Howard Hughes percentage. And then lastly, another sort of set of comps are the non-traded private equity perpetual vehicles. These vehicles are effectively the private equity equivalents of the non-traded REITs like BREIT with substantively similar terms. The main difference here is some charge higher performance fees. So for example, KKR's vehicle has a 15% performance fee. So, if you were to compare it to the example from the prior page, that 2.7% all-in fee ratio for BREIT would be closer to a 3% all-in fee ratio for KKR's vehicle.
Why don't I take over here, Broth? Other point that I think is meaningful is the incremental fees or service fees to Pershing Square here are approximately half of what we're charging Howard Hughes. Why is that? Well, one, the fee we're charging on our own capital is sort of fees that we're paying ourselves. That's not incremental fees to Pershing Square. 31% of the fees that we're charging relate to fees on fund. We're going to be rebating to our clients the fee that we charge them on their investment in Howard Hughes, so they don't pay a double layer of fees, right? So we have existing funds own 19 million shares. Those 19 million shares will pay a management fee by virtue of, or a service fee by virtue of the arrangement with Howard Hughes. So we're going to reduce the Pershing Square funds fees that they pay us by a like amount. So the net to us is actually 52% of what we charge Howard Hughes. At a $90 share price, that's $42 million of incremental fees, or about 0.8% of Howard Hughes's market cap at a $90 a share arrangement. But so the question is this a windfall for Pershing Square? And the answer is it's not. The Howard Hughes capital will represent about 27% of our aggregate fee-paying capital. But since Howard Hughes is not going to pay us to promote, the fees will be something in order of 5 to 6% of the total revenues of Pershing Square. So our revenues will go up by 5 to 6%, but we'll be responsible for managing, a lot more assets. And I think a better way to think about this, maybe the clearest way to think about it, is we're going to have an investment of $1.3 billion in the company. We're going to net an incremental, the scenario here is if Howard Hughes stock price were to go up by 20%, we'll generate 50 million of fees that we can use to offset our costs associated with overseeing this investment. But the profit on the $1.3 billion will overwhelm the incremental fees. So we'd make 260 million on our stock investment, our management team's investment in Howard Hughes if the stock went up 20%. But if the stock went down 20%, we'd lose 260 million and we'd collect only 34 million of incremental fees. So the investment we're making in the company, how that does overwhelms any incremental benefit from the fees. The bottom line here for us is, we've proposed a arrangement that works. We're basically putting in place, one way to think about this is the Howard Hughes Holding entity is a shell. We're putting in place, a driver, 1,000 horsepower engine, et cetera. That shell couldn't afford if we actually charged a market fee, just would be completely uneconomic. So what we're doing is we're setting a fee in line with what we charge to manage other assets, and that will go toward covering the costs associated with our oversight, but it's not some huge incremental profit opportunity for the firm because we're only getting the benefit of half of these fees and there's no performance in other fees. And investors have the alignment of a management team that has $1.3 billion investment, a $900 million incremental investment at the time we take over the company. And I think the simplest way to think about this, and I don't want to spend too much time on this, but I know it was definitely a hot button issue for a number of people in the comments, is will the addition of the Pershing Square team, our investment expertise, our hedging capabilities, our ability to build this company into a successful diversified holding company, are we going to generate 150 basis points per annum of excess return versus the status quo? Can we generate 1.5% more IRR in exchange for the resources we're going to bring? And I believe the answer to that is overwhelmingly yes. And if you look at our long-term track record, in particular, our track record of the last 7 years since we've been managing permanent capital, the fact that we're starting with a relatively small base of equity here, it's a lot easier to compound $5 billion of equity at a high rate than it is to compound hundreds of billions of equity at high rate. And that we find particularly appealing. Another question that was raised by some is the company has put out a net asset value calculation on a periodic basis over time. And while $90 represents a 46% premium to where the stock was trading, it's a discount to where management has set net asset value. And I think net asset value is a reasonable construct for Howard Hughes investors to think about as they invest in the company, but it is a very different construct from net asset value when you compare it to real estate investment trust. Well, and I think you can see that when you look at the chart. This is Green Street's equal weighted average of REITs that tend to trade in and around Green Street's estimate of NAV. So NAV looks like, with respect to real estate investment trust, a pretty good measure. Sometimes stocks trade above NAV, sometimes they trade below NAV. Think COVID, think financial crisis, those kind of difficult periods, they tend to trade at a discount. But the ordinary course, they're plus or minus 10% versus NAV. So NAV looks like a pretty good metric, and therefore buying at a discount seems like would be a bargain. Now, interestingly, if you look at Howard Hughes's NAV, Investor Day NAV calculations, stock has traded at anywhere between a 37 and a 39% discount since the company has reported a public NAV. So either this means the public NAV or the NAV that management has disclosed is very wrong, or for some reason investors are assigning a big discount to it. And our $90 price, by the way, is a 24% discount to management NAV. And the reason why we think NAV is not a relevant construct for the company issuing stock here is, if you think about the REIT example, if there's an apartment REIT trading at $50 a share and NAV is 75, if you issue stock at 60, it's going to be dilutive because the alternative for the company is to liquidate. So if an apartment REIT liquidates, it should be able to achieve that $75 NAV value because it's a flow-through entity for tax purposes. So there's no tax friction in the entity itself. Putting aside the cost of, if there's debt that has to be refinanced, et cetera, there may be some transaction costs, but you've got something pretty close to NAV. So if you could take control of an apartment REIT trading at 50 cents to NAV, you could make a lot of money doing so. Howard Hughes is a very different animal. Number one, it's a C Corp. And as a C Corp, there is a layer of corporate tax, today 21%. When you pay that tax relative to any tax gains on assets. The assets of Howard Hughes in most cases are their tax basis is well below market value. So there's a big tax cost if you would try to liquidate Howard Hughes. The other more material consideration is that 2/3 of Howard Hughes' NAV, marked using the most recent sale prices, or alternatively doing a present value of the cash flows that you could expect to earn on that land over a multi-decade period of time, 2/3 of NAV is land. And there is no market for Howard Hughes to sell, a few thousand acres in one of its MPCs. There's a very active market where on a quarterly basis, the company holds auctions, home builders compete in those auctions, and the company's able to realize a growing has been able to increase land prices kind of over time. But if we tried to dump all that land in the market, there is no bid for those assets. We were able to buy into what we call Terravalis in Phoenix at a very attractive land value because we were the only bidder. And that was a $600 million transaction. It was a relatively small transaction. This company owns called $7 billion of land the universe of people who are prepared to buy, $7 billion of land at a price a home builder will pay for, 1% or 2% of that land being sold over the course of a year, it sort of doesn't exist. The other really important point about Howard Hughes is it's an organic going concern. For people less familiar with the business, when you own a small city, the advantage you have is very different than if you're a real estate developer building a building. The advantage you have is Howard Hughes owns substantially all of the commercial land in its NPCs. It owns all of the unsold residential land in its NPCs, and it owns a very high percentage of the income producing assets. That creates a very different competitive dynamic when Howard Hughes goes to, when there's a 200,000 square foot tenant looking for space, they're not bidding one landlord against another. If they want to be in the Woodlands, they've got to be basically in one of our buildings. And that enables us to, have a better negotiating leverage, if you will, with the tenant. And because we own substantially all the commercial land, we only build when there's demand. We never have the problem that they have in, let's say, downtown Houston, when there's, the market improves, there's demand for 1 million square feet, and you have, 3 developers build, million square foot buildings, and all of a sudden the market's overbuilt. Think Austin, Texas. There was, it was a great market until a bunch of developers at the same time built a lot of Class A assets, and they're now competing with each other. You don't have that problem in NPCs, but if you try to sell the land or the income producing assets off separately from the commercial land or to different buyers, so the company has looked at, over the last 14 years, lots of different alternatives to create value, including a sale of the whole company. When we at various times looked at a potential, could we sell off or spin off income producing assets? And ultimately we concluded that would destroy value. So while, the company's NAV, hopefully it grows sort of over time, is an interesting metric to judge the progress of the business. It's not a number that could be realized in a liquidation. And by the way, it's not a number that includes, the operating costs of running this company. Our view on Howard Hughes is it's a very well-run master plan community company, but as a standalone company in one business, it is at risk. Pershing Square, as a 14-year shareholder, has stepped in both at the inception of the company, and at various times to help the company recapitalize when the capital markets shut. But as a standalone single B to double B, rated company, we think it's not a great standalone business, and I think that's been proven for better or worse over the last 14 years by a stock that has perennially traded at obviously a very large discount to NAV, and one that has not really generated a meaningful return for shareholders. That's reflected in this chart. The early days of Howard Hughes, there were rumors, and then eventually a cover story. At the risk of this, of course, I was on a cover of Forbes magazine, and the reporter wrote an article saying this is it's going to be Bill's Berkshire Hathaway. The stock ran up to whatever, $150 a share. When we didn't turn it into Bill's Berkshire Hathaway over time, the stock went back down. And now we would like to turn it into Pershing Square's, as we say, modern day version of Berkshire Hathaway. And then an obvious question, of course, is why will new Howard Hughes trade at a better valuation and generate higher returns than standalone Howard Hughes? And we think the answer to that is, several-fold. One, stocks trade on the basis of supply and demand. We are not increasing the supply of Howard Hughes shares. The float of the company is not changing. We are, however, in our view, going to meaningfully increase the demand for Howard Hughes shares. It's going to be some turnover from, if we do this transaction, from a pure play real estate investor that wants nothing to do with a diversified holding company. So there'll be some investors who will sell. But we also believe there's a much, much larger group of investors who would love to find a long-term compounding vehicle run by a aligned management team, in this case, investing $1.3 billion of their own capital alongside the public at a huge premium to market value, taking a modest amount of service fees to cover a portion of the costs that we will assume when we take over this entity. But again, our $1.3 billion investment vastly overwhelms any material benefit from the net $40 million of potential fees that we will receive from the entity. The $40 million will not cover our allocable costs, the allocable time and energy that we're going to put into making this company successful. We've also said that $900 million investment is a permanent one. We will never sell it. We're going to own it forever. And you can judge us based on the success of the stock over a very long period of time. I wish I could take the job for $100,000 like Mr. Buffett did, 60 years ago. And I could do it on my own, and I had nothing else going on, and I could, but even then I would have to hire a real team. People think perhaps Mr. Buffett just working away in a small office and that's creating all the value of Berkshire. The reality is there are a lot of very highly compensated people at Berkshire who make millions and tens of millions of dollars running their various businesses, investing the capital of the company, executing transactions. Howard Hughes could not afford to hire this team internally. So certainly at the start, we are giving a deal where Howard Hughes can get the full benefit of the team without bearing the full burden of the costs associated with the team. The other point I would make is, as a pure play real estate company, 2/3 of its market value in land, that does a lot of development, that doesn't pay a dividend, that's a C Corp. It's a relatively small market cap entity that has a geographically dispersed collection of assets, that does not report a metric that you can really model the company on. It's a very difficult company for analysts to cover. It's a very difficult company for a new shareholder to do due diligence on. And that really hampers the universe of people who can own the stock. We think there are a much, much larger group of investors that would like to invest alongside Pershing Square, that will buy and hold the stock for the very long term, and that will overwhelm the pure play real estate investors that will choose to sell. We also importantly believe that while we can't guarantee we're going to hedge every black swan risk that occurs over the next 30 years, we've done a very good job over the last 21, and that hedging capability we bring to Howard Hughes. One successful hedge pays for 20 years of service fees. With that, we're going to go to Q&A. We'll give everyone why don't we resume at 10:15, and we will do spaces, and I will launch that spaces from my account. So just go to Bill Ackman, and there will be a spaces that you can follow, and we're going to take the questions we receive in the order in which we receive them, and I appreciate your patience. Thank you so much.